Hello everyone. Welcome to this discussion of the Hindu editorial. Today is 14th of March, Saturday, and here is the editorial for today. This has been written by the Sashi Tharu sir. Uh, the faith of the Washington Consensus once talisman. So let us try to understand what he is trying to say. So uh, he start writing with once upon a late 20th century lecture circuit, the phrase Washington's consensus did the work for talisman, 10 TD policy prescriptions that promised macro stability, market-led growth, and a path out of crisis for beleaguered states. John Williamson, who coined the term in 1989, formulated its 10 commandments: fiscal discipline, reordering public spending toward pro-growth priorities, tax reform to broaden the tax base and lower rates, liberalization of interest rates, competitive exchange rates, trade liberalization through lowering tariffs, liberalization of inward foreign direct investment, privatization of state-owned enterprises, deregulation to remove barriers to entry the competition, and securing property rights. So he is actually trying to say about the Washington Consensus, which is trying to basically talk of 10 points which must be on upon which there must be consensus. Okay, these include the fiscal discipline, reordering public spending toward pro-growth priorities, tax reform to broaden the tax base and lower rates. Okay, and so on. So this is. You see there is a disruption on these 10 points of the Washington Consensus. Okay, so that is happening because of the war or because of the decision of the Mr. Trump, the US president. Okay, these were presented as near universal remedies administered by institutions in the West that watch the global macroeconomy like physicians with a single favored prescription sum up in the words liberalize, privatize, and deregulate. 3 decades on, the prescription seems obsolete, overtaken by onrush of global events. It's shaping it's shaping its legacy. The Washington consensus was never merely technocratic. It carried a political history. Adopted in moments of crisis, its reforms arrived bound up with conditionality, bargaining power, and a belief that markets, once set free, would generate growth that trickled down. Okay, so Dr. Sachi Tharu is trying to say that this Washington census was not only the technocratic. Okay, means it was not only on the paper, or it is not only a matter of the policy, but it was implemented on the ground. Okay, and it carried out a political history. Okay, it was adopted in the times of crisis, and its reforms arrived bound up with conditionality, bargaining power, and a belief that markets, and there was a belief that markets, once set free, would generate growth that trickle down. Okay, so means that if there will be trade between the countries, between different countries of the world, then there would be there would be growth generation will happen, and that growth will trickle down. Trickle down means that will get distributed among the members. Okay, among the members who are involved in trading. Okay, so that is what was the belief, that the market must be set open, set free. Okay, the core tenets of the consensus emerged from the ideological crucible of re-agonomics and Thackerite structural adjustment program. These principles, fiscal austerity, fiscal austerity, uh, deregulation, privatization, and trade liberalization were adopted with little critical scrutiny by Bretton Woods institutions, the World Bank, and the International Monetary Fund and BWIs. Okay, So what are these principles? So these principles are basically fiscal austerity and deregulation, privatization, and trade liberalization. Okay, these are the few principles out of 10 principles which are talked about in the so-called Washington Consensus. Okay, so these were adopted with very little critical scrutiny. Okay, so before adopting, they have not been thoroughly investigated by the Woods institutions, which are World Bank, International Monetary Fund, or BWIs. Okay, and their regional counterparts such as Asian Development Bank during the mid to late 1980s. Their embrace was largely a response to debt crises and macroeconomic instability that afflicted many developing countries at the time. Yet the consequences of this orthodoxy were far reaching and, in many cases, deeply destabilizing. The Asian financial crisis, which erupted in Bangkok in 1997, and the global financial meltdown of 2008 were among the most visible symptoms of the consensus systemic flaws. Okay, so when did this Asian financial crisis happen? So it was happened in 1997, which was erupted in Bangkok. Okay, and then global financial crisis, which is also known as the Great Depression, happened in 2008. These were the among the most visible symptoms of the consensus systematic flaws. Okay, so these are the consensus systemic flaws. Okay, means Washington census has been failed. Okay, and that is something which we can notice from the Asian financial crisis that happened in Bangkok in 1997 and the global financial meltdown of 2008. Okay, now, equally telling were the breakdowns of the WTO ministerial meetings in Seattle 1999 and Cancun 2003, which exposed the deepening rift between developed and developing nations, a divide the Doha round never managed to bridge. One of the most damaging legacies of consensus was its categorical rejection of industrial strategy, promoted by the BWIs on behalf of industrialized nations. This taboo was reinforced through WTO rules on trade-related investment measures, intellectual property, and subsidies, all of which constrain the policy space for developing countries seeking to nurture domestic industries. Another pillar of Washington census dogma was deregulation in favor of an idealized free market, even in contexts where market institutions were weak or non existent, as was the case across much of Africa and least developed countries. For decades, the IMF advanced the notion that inequality was irrelevant so long as growth occurred and would eventually trickle down. In practice, however, structural adjustment programs proved particularly harmful to the poorest nations, which lacked even the minimum institutional foundations upon which the Washington Consensus assumptions were built. Compounding these issues was the manner in which the Washington census was conceived, largely in Western capitals, without meaningful consultation with the developing countries that would bear the brunt of its implementation. The results were mixed enough to invite reappraisal even during the Washington census heyday. Some countries, parts of East Asia, Pinochet's Chile found ways to combine market openings with a strong state direction and industrial strategy. Others, several Latin American cases, some post-Soviet transitions suffered debt crises, inequality spikes, and social blacklists. A loss of faith. The conditionalities imposed by BWIs and the rigidity of WTO rules led to widespread discontent manifesting in a street protest across the global south throughout the 1990s and beyond. Okay, so he's trying to say that the conditionalities which was imposed by the BWIs and the rigidity of WTO rules led to widespread discontent manifesting in a street protest across the global south throughout the 1990s. Okay, Why? Because these were favoring to developed countries, not the developing countries. Okay, and global south is, global south is a is section of those. It is representing those countries who are poor, who are underdeveloped, who are developing. Okay, that is why there was a widespread, discontent has been manifested in the state protest across the global south throughout the 1990s and beyond. The backlash against globalization, whether from the anti-capitalist left in earlier decades or the far right after 2008, with its toxic blend of white supremacy, racism, and anti-immigration sentiment, can be traced at least in part to the failures of Washington census and the global financial crisis. It helped precipitate movements such as MAGA and Brexit reflect this disillusionment. Ironically, none of the countries that successfully industrialized, neither the United States nor Japan before the Second World War, nor South Korea, Taiwan, or Singapore in the post-war era, adhered to Washington census prescriptions during their formative years. Their success was rooted in state-led strategy that prioritized industrial policies, precisely the kind of intervention the census sought to delegitimize. The Washington census may have dominated the late 20th century, but its time has passed. The task now is to craft a new consensus, one that is inclusive, context sensitive, and responsive to realities of multipolar, digital, and ecologically fragile world. Okay, so he's basically trying to say that Washington census is no longer relevant to the present day, and that is why there is a need of crafting a new consensus that should be that should be inclusive, context sensitive, responsive to the realities of the multipolar, digital, and ecologically fragile world. Okay, so that is what he's trying to say. We must revisit the policy mix that enable the rare post-war success stories, South Korea, Taiwan, in its own way, China, to ascend into the ranks of advanced economies. This does not mean a wholesale return to 20th century models, but rather a thoughtful adaptation of their core principles to contemporary challenges core principles to contemporary challenge: education, public health, infrastructure, investment, and infant industry protection remains as vital today as they were then. But new imperatives, digital trade, climate resilience, and AI governance demand fresh thinking and innovative frameworks. We are witnessing new trends. One, the emergence of a post-Washington consensus that insists on public accountability, social safety nets, and politics of redistribution. The other, the Beijing counter-narrative, where state-led intervention, targeted industrial policy, and limited political liberalization offer an alternative template. Okay, so there are two type of trend that is emerging. First is the emergence of post Washington consensus that insists on public accountability, social safety nets, and the politics of redistribution. And other is the Beijing counter narrative, means Chinese, where state-led intervention, targeting industrial policy, and limited political liberalization offer an alternative template. Now, next, if the 20th century was a triumph of liberalization, the mid 2020s have seen its theatrical undoing in the form of the Trump tariff tempest, sweeping, irritating, and punitive. Protectionism is being brandized as an instrument of geopolitics and domestic politics alike. Supply chains are being reconfigured, and not so much for efficiency but for dominance and national security. The implicit margin that underwrote the Washington census, that free states would be the engine of prosperity, supply chains, the neutral plumbing of global commerce, has been stained by a revived appetite for economic nationalism, and the widening of the sovereign power as a battle axe rather than a shield. Tariffs and industrial subsidies signal a politicization of economic policy. They reveal that Trump's America is willing to accept short-run cost and global friction to reclaim perceived strategic advantage. If in 1990 the default was liberalized, in 2025 the default is what will protect our interest. The shattering of a myth. Has the world moved to a new consensus? Not exactly. What has emerged is less a single set of new varieties and more an acceptance that policy must be politically context sensitive. A pragmatic eclecticism now rules. Fiscal prudence still matters, but so does targeted public investment. Markets are powerful allocators, but they need rules, institutions, and buffers. Trade is growth enhancing, but national security can justify strategic decoupling, and politics can justify tariffs. The neat ideological narrative, liberalized, privatized, deregulated, has given way to a toolbox from which policymakers pick instruments with explicit geopolitical and distributional aims. In that messy landscape, success will come from the hard work of designing policies that fit national capacities, global constraints, and political realities. That is not the end of globalized liberalization. It is the end of the myth that there is a ready-made template that every nation subscribes to. The struggle to grow and prosper is still every nation's struggle, but each has to find its own path forward amid the policy mess into which all have been plunged. Okay, so I hope that this much is clear. Now let us summarize quickly. Okay, so Washington Consensus is what? So Washington Census was developed in late 20th century, which is basically talking about the 10 policy prescriptions. Okay, policy prescriptions means that the state or the modern country should ideally adopt these things, or should focus on these 10 prescriptions, these 10 points. Okay, so what are these? So and why these 10 points are important? Because this will provide macro stability means economical stability, market led growth, and a path out of crisis for the laggard states. Okay, then let us quickly see the 10 these 10 points. So fiscal discipline, you have fiscal discipline, then you have reordering public spending toward pro growth priorities. Okay, which means that you should not you should not spend money on anything which is not going to lead growth. Okay, for example, elimination of property, it is elimination of poverty, it is not going to give you any profit, it is not going to yield any growth. So hence country should not spend money on elimination of poverty or any social sector scheme which will not yield economic growth. Okay, and if money left after you have spent money on those sectors where from where you will be benefiting, you will be yielding economic growth, and then you can do some spending on social sectors. Okay, so that is what he is trying to say, that you are reordering public spending toward pro growth priorities. Then tax reform to broaden the tax base and lower rates. Okay, why tax reform is important? Because if you reform the tax structure system, or tax reform, if you bring the tax reform, then what will happen, that the revenue or the public receipt will increase. Okay, public revenue will increase. Okay, then liberalization of interest rates. Okay, so interest rates must not be very high, because if you keep the interest rate low, then what will happen, then the investor will or the borrowers will borrow money from the banks, and then investment will come. Okay, so ultimately it will lead to the creation of industries, creation of job, and then it will also help in increasing the consumption. Okay, so that all things, you know that these all things are interlinked. Okay, then trade liberalization through lowering tariffs. Okay, so your tariff must not be very high, it should be limited, okay, or it should be nullified. Okay, so that is how trade should be competitive. And then competitive exchange rates. Okay, so exchange rate means the you are easily able to exchange your currency with another country of another country. Okay, so that is thing. Then liberalization of inward foreign direct investment. Okay, means that whatever foreign direct investment that is coming to one's country, that should be liberalized. Means that there should be less regulation, there should be minimal rules, laws. Okay, means that if anybody is trying to do foreign direct investment in a country, then he should not be traveling in doing that. Okay, he should be easily doing that thing. Then privatization of state owned enterprises. Why privatization of state owned enterprises? Because it will help state to generate more revenue. Okay, and the earlier the maintenance cost that state was burdening, and even if it the profit this so-called private state-owned enterprises were not generating, it was the state who was funding the jobs there. So that is not good thing for the state, because it is reducing the revenue. So in order to increase the revenue, privatization of state-owned enterprises should be carried out. Then deregulation to remove barriers to entry. Yes. Then competition and security property rights, securing property rights. So these were considered as near universal remedies. Means this will continue everywhere. This will continue in each and every circumstances. Okay, it does not matter whether there is a war, there is a crisis, there is a normal social situation. Okay, so all these things will universal. Okay, and these were administered by institution in the west. Okay, like IMF, World Bank, okay, etc. So these all are the things. So and then we also understood that the Asian financial crisis happened in 1997 and global financial meltdown of 2028. These were among the most visible symptoms of the consensus systemic flaw. Okay, so the consensus is no longer very much relevant to us. Okay, I hope that this much is clear. Okay, the India Canada turnaround is about deliverables, so we'll not discuss this. Let us see, is there anything else we can have? Let us see the Indian Express. Is there anything we can discuss? Okay, so this is the. Let us see the Indian Express economy section. So why FPIs are dumping Indian stock, pulling pulling rupee down. Okay, so let us see. This is important for our examination perspective, because if you see the previous year question have been come from these type of you know things. Okay, at a time of global market volatility, investors tend to cut down on the risk they are exposed to and withdraw from emerging markets such as India. Staying invested in a foreign asset where the currency is weakening can hurt returns for foreign investors in terms of their own currency, such as the US dollar. This incense is why foreign portfolio investors (FPIs) have continued to dump Indian shares amid the war in West Asia and volatile crude oil prices, dragging down the Indian rupee, which hit a new all-time low of 92.48 dollar on Friday. Investors have sold Indian shares on a net basis every day since Israel and US attacked Iran on February 28. So far this month, foreign portfolio investors have net sold Indian shares worth $5.73 billion. This is the most that foreign investors have pulled out from Indian markets in 14 months, even though less than half the month is over. The last time FPI sold more was in January 2025, when net outflows amounted to just over $9 billion. Since the start of 2025, FPIs have been net sellers of Indian shares in 10 out of 15 months. Sale of Indian assets denominated in the rupee lowers demand for the Indian currency and cuts its value. As such, the continued sale of Indian shares and other assets such as the government bonds by foreign investor leads to the rupees fall as so it is important. The continuous sale of Indian shares, okay, and other assets such as the government bonds by foreign investors leads to rupees fall as it constitutes an outflow of foreign money from India, similar to the impact of widening trade deficit from the more expensive oil. So why this is happening? Okay, so what happens if money is going out of your country? So basically, money is going out of the country. So what will go out of India? It is not rupee. It will be certainly dollar. Okay, so we will have less variety of the foreign reserves, and because of which, what will happen? Our money with respect to the foreign assets, foreign sorry, for forex, foreign money will start depreciating. That is what is happening. Okay, so you see the continued sale of Indian shares and other assets such as government bonds by foreign investors lead to rupees fall as it continues an outflow of foreign money from India, similar to the impact of a widening trade deficit from more expensive oil. We downgrade India to neutral as the equity market enters a delicate phase. However, Fook, CIO of Singapore-based DBS Bank, said on Friday, while growth, policy support, and demographics remain supportive, rising risk warrant a more cautious view. AI disruption is weighing on the IT services sector, while export-oriented industries face intensifying competition from China and Southeast Asia, particularly in autos and auto components and rising cost and EV pressures, he said. The exit of foreign money from Indian source has not been limited to the stock market. For FDI, foreign direct investment, seen as more stable form of foreign investment than in the stock market into India, saw net outflow in 3 of the last 4 months of 2025 as per latest available data from the Reserve Bank of India, well before the conflict began in West Asia. In fact, economic survey for 2025-26, which was stable in Parliament on January 30, had warned that the paradox of 2025 had been that India's strongest macroeconomic performance in decades has collided with a global system that no longer rewards macroeconomic success with currency stability, capital inflows, or strategic insulation. Strategic insulation. As a result, the rupee's valuation did not accurately reflect India's stellar economic fundamentals, which was causing investors to pause. The rupee, which fell below 90 and 91 per dollar in December, breached 1992 earlier this month. And if crude oil prices remain elevated and average 100 rupee $100 per barrel in 2026-27, economists expect the rupee to weaken further. Okay, so rupee is going to weaken further if the crude oil prices is persist to increase. According to a scenario analysis by Quant Eco Research economist, if oil averages $100 per barrel in the next fiscal, the rupee would weaken to as much as 98.5 per dollar. While the fall in Indian stock market has been sharp, Sensex and Nifty 50 dropped more than 5% this week, marking their biggest weekly fall in the nearly 4 years. It has been lower than in some other markets, such as South Korea's Kospi, which have been riding high on AI wave. While the Sensex and Nifty 50 are down around 9% since February 26, and Kospi has crashed by more than 13% over the same period despite gaining around in recent days. What makes the South Korean sell off stand out is its severity. Okay, so I think this much is important. Dave Chia and Stephen Angrick of Moody's Analytics said in a note, the drop after the outbreak of the conflict is broadly comparable to the decline seen after U.S. President Donald Trump announced his Liberation Day tariffs last April. In most other APAC economies, equity losses have been far less pronounced. The main exception are Thailand. Exceptions are Thailand and Indonesia. According to Japanese investment bank Nomura, Thailand is the most vulnerable Asian country to shock from Iran's closure of a Strait of Hormuz, followed by South Korea and in India. Analysts expect Indian markets to stay volatile in the near term as tensions in West Asia keep energy prices elevated and sentiment fragile. Mm. So why the rupee is depreciating? So this is depreciating because of the fact that the FPIs means foreign portfolio investors are pulling out their money out of India, pulling out their money from India. Okay, thank you.